From the morning reading, IWM leads with a support bounce. The Q's another all-time closing high. Breadth strengthened compared to the prior session as advancers led 1923 to 1075 on the New York Stock Exchange and led 1808 to 967 on the NASDAQ. In other news, the bar is set high for earnings season. For the first time since the summer of 2014, we're entering an earnings season at a time when optimism has been extreme. Even though this remarkable bull market, stocks have struggled during the first month of earning releases when optimism was so high to begin with. Small stocks are stuck in a small range. We looked at the tight high to low range of the S&P last week, and the small cap Russell 2000 is showing the same pattern. An extremely tight range over the past month after surging to an all-time high. Its returns going forward were okay in the shorter term, not so much in the medium term. The NASDAQ closed at another new high. It has been up for 6 straight days, and the last 4 of those actually showed more declining stocks than advancing ones. The few times that has happened before, it declined an average of nearly 30% at its worst point during the next year. Large cap options traders are betting on a decline. The OEX Determination Index has been hovering in extreme territory, meaning that volume in the S&P 100 index options have been focused on increasing exposure to the decline. Since 2010, there have been 105 days when the determination index was above 60%. Over the next month, the S&P showed a positive return on only 35 of those days for a 33% win rate, and had an average return of negative 1% and a 2-to-1 risk to reward ratio. By contrast, there were 153 days when the determination index was below 40%. After those, the next month was higher 108 times, a 71% win rate, by an average of 1.7%. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:09 a.m. Mountain Time, and I'm recording this in preparation for the market day of January the 11th, 2017. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Let's go ahead and take a look at the morning report. And at the time of this cut, all 4 of the U.S. broad-based indices were hovering around scratch. Crude oil is up about 1/3%. Euro is down about 0.5%. Long bonds are up just over scratch, and gold is up just a hair less than 0.25%. In overseas action, all 5 of our markets are open. China is down about 0.8%. Hong Kong going the opposite direction, up about 0.8%. Japan's up about 1/3%. Germany is up just above scratch, as is the United Kingdom. In terms of macroeconomic reports for today in the United States, of note, you had the weekly crude oil inventories report and a 10-year bond auction. Looking forward to tomorrow, you have the weekly unemployment claims, FOMC member Evans and FOMC member Harker speaking. You have import prices and nat gas storage, along with a 30-year bond auction. Also note that Fed Chair Yellen will be speaking tomorrow night. In terms of current volatility conditions, very, very low. Short-term VIX is at an 8.88. Skew is benign. IV percentiles are approaching single digits across all 4. S&P is at 10. The RUT at a 2. The NASDAQ at 11. The Dow at a 13. We did have a standard deviation size move put in yesterday by the Russell. And let's go ahead and go look at that chart. The Russell, with that standard deviation move, just went right back into the range. It had been tickling the bottom of this range and this area of support that we had talked about with this channel. There's some moving average lines as well as the bottom of this recent range, and it tickled that both the prior session and yesterday. But with yesterday's action, you ended up with a engulfing candle. Now, that's bullish on a short-term basis. Obviously, it's more significant when you get this at a kind of turning point, swing kind of level. This is really just at a area of support. So it has some meaning, but it's not as bullish a candle as it can be in other locations. As we've been talking about, like this 2 standard deviation size move here and this -1 standard deviation move here, this is all noise as long as it stays inside the channel. So it tickled by a few cents. That's just enough for the algorithm computer traders to kind of run some people's stops, ran those stops, accumulated, and then reversed. So right back into the middle of the range we go with the Russell. And other bullish action, you have the NASDAQ, and it's been making a series of new all-time highs. And you see well up over 5,000 now with the NASDAQ. So very interesting action here in the short term for the NASDAQ. More intermediate term, remember the NASDAQ had been the one that had been lagging behind the other indices. Well, it is now leapt to the front, and it's the one that's put in the series of higher highs and higher lows and is leading to all-time highs. In the big board, S&P futures that we like to watch in terms of the real benchmark that has the most meaning, you did have just a few sessions ago the new all-time high, and it is kind of set back into a little bit of a consolidation since then. And appearances are that this is just another bull flag setup for the S&P futures. And the other big board, as they call it, the Dow, it's also in a sideways consolidation pattern, much like the Russell. And really everything that's happening between the highs and the lows is pretty much noise. And crude oil has really had a pretty significant breakdown in recent action. When we set a new all-time high there, it set up a flag pattern, but then basically stalled when it got back up to the former area of horizontal resistance, and then not only just fell back from there, but actually broke its horizontal support and fell back into the old range now. So in just a matter of a few sessions, we've seen the crude oil market really back off and break a short-term trend. It is now, short-term trend had been very bullish. That has been called into question now. We now have a lower low. We haven't had a lower high and a follow through to a further lower low yet, but we have had a broken trend. So we'll have to see where that goes. Gold, of course, continues to have this big action of retracement. I continue to believe that this is just a retracement and that we're going to continue to then turn and make another lower low, but it certainly is persisting thus far. So you've had this diagonal break and at least a short-term trend change. We'll have to wait and see if indeed the probabilities follow through and this starts to break back down, or if we've actually started to see something more persistent and change in character on the gold market. Now, I'm suspicious about that because as we look at some of these other markets that are similar patterns to long bonds, and we're starting to see consolidation there, just as it's starting to come towards the bottom of the cloud. And then as we look at the dollar looks like it is starting to kind of pick itself up and make some move up off of this recent weakness and back heading towards the all-time highs. If the dollar moves back up towards these all-time highs and breaks that and continues to make new all-time and I say all-time highs, this is actually about a 14-year high. So certainly a very, very long time since the dollar has traded in this range. If the dollar does that, then we will see gold likely break down, and we will likely see long bonds also continue with that breakdown. The volatility, very, very low, and you see very small candles. Yesterday's volume actually, increased towards the closing hours yesterday, and that was on weakness in the equity market. And indeed, it should be noted that in the S&P futures, we ended up with this doji. We actually had a decent range in terms of top to bottom of the range, but we ended up as flat a market as you can end up with. Well, that was on decent volume, and that volume was mostly there at the end as it was coming down from the highs of the day. So you look at this volatility, it's about as compressed as they can get. I mean, we do see sometimes numbers in the 10 handle, but these recent candles have had action that have dipped right to the 10 handle, but have been running in this 11 to 12 range of late. We generally consider this stuff in 11 to 12 to be low volatility, and then the range of 12 to 15 to be that of normal bull market, kind of noisy stuff that we don't get too excited about, whether it's a 12 or a 13 kind of thing. So keep in mind this is relatively low, and that sets us up for a bit of danger for increasing volatility in the potential future. Let's go ahead and take a look at the daily report, and we'll take a look at just where some of those metrics are falling. First of all, on the top here are market timing and posture information, intermediate term phase opinion, market phase 3, the expectation of bull flags and other bullish continuation patterns. Confirmed uptrend is the first market timing signal coming to us from IBD. These are all three mechanical in nature. The first one is bullish. The second one improved a notch back to a 5 out of 6 with the buy signal in place since 11:10, also bullish. And then the third one from Stock Charts Decision Point Scoreboard leaves us with this kind of mixed signals. And these mixed signals, and you look at the short term here, where 3 of the 4 have mixed signals. You see the NASDAQ has been relatively stronger of late. But these mixed signals in the short term and then also on the long term is part of the reason why our expectation currently is that while bullish, and the consensus here is bullish, we're expecting just kind of incremental new highs. It's going to be really difficult for the market to make robust, high energy moves to the top side when you have these kinds of mixed signals. Also, on the flip side, you also are not likely to have any significantly sized drawdowns. Now, certainly we could have several percentage points pullback or even a correction within the context of a bigger bull market at any time. We never rule that out. But the likelihood, the probabilities are that any kind of correction or pullback at this time would be relatively mild and relatively short in duration. The problem for you is that especially if you're taking short-term option swing trades to the bullish side, is that we have very little expectation for significant new high movement as well. So we're kind of trapped in this compressed action, albeit slightly to the bullish side, not really making a lot of progress to either side. So if you're doing a lot of time-sensitive trading, you got to be kind of aware of that kind of set of indicators and what they're telling you, because at the same time, while your investments aren't getting necessarily hurt and perhaps making incremental advances, your more speculative trading, your shorter-term trading could be subjected to a lot of theta eating time and the requirement of a lot of patience to be able to get to any kind of significant size targets. Now, individual charts can certainly be more powerful, and that's something to also consider. But you might want to make sure that you truly got everything stacked, that you got the different time frames stacked, and that you have the broad market, the sector, and the industry group all supportive of your individual stock signal. So give as much energy as possible to the follow-through of that short-term trading time frame. So we're mostly talking about intermediate-term investing and trading when we refer to the top of this. But I did think I would take a little bit of a tangent and just mention what the implications are to this, to your shorter term trading. In terms of position sizing opinions, both models are at 100%. Intermediate term market posture is an exceptionally strong bull with an exceptionally strong bullish sentiment line. And that's given to the fact that we're up over 80 on especially the S&P, but also the Dow and the NASDAQ are also up in that area. Oh, I forgot to turn the color on this, but the strong bull is back on the Russell. It did flip to a new signal with an improved intermediate term market posture, so that's no longer a warning category and is also in the bullish camp. In terms of hedge warning status, level 0 plus, normal, with some elevated conditions, and we'll talk about those elevated conditions in just a moment. Strategy opinions, the only thing that's really out of kilter at this point is under option income strategies. That opinion has us with below the acceptable range. Anytime we drop below 12, we do put a caution about the initiation of new positions for novice traders, and this is due to the fact that your premium that's being paid is relatively low compared to the amount of risk that you're taking on. Now, we have been kind of bouncing back and forth between the 11 and 12 handle, so kind of keep that in mind, but overall premiums are certainly relatively low at this point. Now, into those specific areas of warning, most of this in the volatility area is looking at, various perspectives of volatility being low, and then from that low posture being in a position to increase volatility. So this condition can persist for really an outstanding amount of time at times, especially during the summer doldrums or during that time between Christmas and New Year's when volatility often dries up. This time of year, that's not usually so true. And we certainly have a number of things to keep an eye on. The volatility ratio warning has reset back into its firing position. The VIX is below a 12. The daily futures on the VIX are in a squeeze. And even the distribution day count, which on the NASDAQ had persistently been so high for so many weeks, it's only down to a 5 now. If that drops one more notch to a 4, that will drop out of warning status. So that itself, I think, is something of interest. Skew is benign. Everything else very, very, very low. So in bull markets, this is the condition that can persist, but at the same time, we look for those signs of increasing volatility to tell us that something more or new is developing. Under the trend-based area, everything is fine. In the market risk aversion indicators section, we have ones that has now gone from rolling up to risk on. We'll watch the remaining 4 and see if they start to follow that pattern, and we have a improving bullish set of signals coming potentially from the intermarket risk aversion indicators. From a sentiment standpoint, not particularly extreme on any of the markets, and the fear and greed index you see has fallen down to a 62, so starting to move towards the neutral area. In terms of sector specific, our winners yesterday: financials, consumer discretionary, industrials, materials. These are all risk-on kinds of sectors. So pretty much a risk-on. You look down here at the bottom, real estate, consumer staples, utilities. 3 of the bottom 4 are normally defensive in nature. And the other defensive one, telecom, you could see essentially was scratch, with one of the 2 big companies being absolutely neutral and the other one being positive. So pretty much a risk-on day yesterday with that support bounce that you got from the Russell, as well as the especially risk-on appetite of technology that you get with the NASDAQ. And you see, actually, overall, technology was essentially scratched, and you see the breadth was actually relatively even, and that was one of the things that the morning author mentioned as well. So we've had a series of new all-time highs on the NASDAQ, which is technology rich, and yet that's been done on the back of fewer and fewer companies. So that's a bit of a warning sign for you NASDAQ traders that there may be some signs of exhaustion starting to show on the NASDAQ. In terms of market posture by time frame, by sector, you can see it's quite a mixed bag here, quite a Christmas tree light here. So not a lot of great places to be going in terms of consistency. Certainly up to this point, technology, materials, industrials, healthcare has been certainly improving of late, consumer discretionary and telecom. Most of these with consistent up patterns are the risk-on areas. And then we have, on the flip side, retail, utilities, financials, especially the non-regional banks, energy, and consumer staples, on the weaker side. So kind of a mixed bag, both defensive and risk-on, going both directions here. That probably also is something of a signal. In terms of percent change, you can see we're starting to see a little bit more red in the 5-day and the 1 month. So again, some of these markets which had been performing so well, starting to go sideways and starting to really kind of chatter after, we had about a 5-week period there in the post-election period where it was pretty much a power play. And that seems to have ebbed off, and we're now starting to see some real sideways action. And the sideways action is coming across from virtually every single sector. Okay, I think that's enough for today. Let's go ahead and wrap this up. And I'm going to scroll through these for about 22 minutes at this point. I don't normally like to go more than 20. Here's your disclaimers. Hit the pause button if you need more time to read the disclaimers. Also note the hyperlink down here at the bottom of the slide for the full set of disclosures. We should be back here for our next market preview session for tomorrow. In the meantime, manage that risk profile, and each and every day seek to go out there and learn something about your chosen trade craft. Good trading.